information on this webinar is general information and should not be viewed as applicable to your individual situation and/or circumstance. We recommend that if you have questions on your individual situation, that you follow up with either your attorney or specific accountant. Please also understand that the information we are providing is extremely fluid, is changing on a daily basis, and often getting superseded. What we present here today may very likely be irrelevant or incorrect tomorrow. As such, please note that it is only accurate as of today, certainly not going forward, and that even as of today, the information is only our best understanding based on how we have reviewed or interpreted the information.
Well, thank you for coming. We appreciate you spending the time this afternoon. We hope you had a great Memorial Day weekend here. And we are coming to you in a little bit of a combined format. Some of this is being pre-recorded and some of it's going to be a live Q&A session. So please know that we're going to present a little bit here on some of the details, kind of go through the scenarios that are the PPP forgiveness application. So that came out. We're going to go through those details first and then transition over to live Q&A to address some of the questions that you have. So again, thank you for coming and spending the time. And my name is John Sluice here and then Jeff Wood. We've got both of us here to doing this presentation so that we're not just looking at myself, but you got both of us here. So thanks, Jeff, for joining.
Yes, you're welcome. So last Friday, the SBA released an 11-page version of their debt forgiveness application. About half of that is chock full of instructions. It contains some new information, some clarifying information, and a couple surprises as well that we will use this shorter summary video to help explain what it is that they're getting after in this application. John and I were talking the other day, and this application really isn't for the faint of heart. There's a lot that goes into it, a lot of detailed reports that need to be attached to it. So you may not want to try to tackle it on your own, but I would still recommend that you read through all 11 pages, make sure you understand as much as you can of it, and reach out to professionals where you have questions, or even to us, and we can take the process over for you. Of course, we'll need some of your help, some of your input, access to some of your information, but we're here to help.
Yeah, and I think getting back to Jeff, what we were talking about here is think of this like a tax return. Could you do a tax return? You can, but you as a business owner, do you really want to dive in to know it? You should know it. You should know the detail of what's going on, what you're signing to, because at the end of the day, you are signing and certifying to the information that's in this document. But do you also want to know every little nuance and every little line? Probably not. You can, and that's why we're doing this video here for those of you that want to dig in and actually dive into and understand each line item by line item thing, because we want you to have the option to do it if you do. But of all things we would challenge and have you think about as the business owner, is this the best use of your time to be really understanding what does FTE mean, what is CPCP and ACP, and what is all these different acronyms and all these different terms. If you want to learn them, you can, certainly. That's what this resource and other resources are for. But really ask, does it make sense? Or since this is a one-time thing, I mean, we're hoping that this payroll protection program is only a one-time thing and that we don't have to do it again. It doesn't necessarily make sense for you to truly understand all of it and rely on your professional. So rely on your accountant or your banker, us or whoever, to really help through this process. Again, you're certifying it, so you have to understand the theory. You need to know, how do we maximize this? But do you really want to ask and know every single little detail here? You know, that's going to, some business owners are going to say yes and some are going to say no. And so I think that's what we're trying to convey here is, hear from us is that we're not trying to not share the information with you. We want to share the information with you. But just like sometimes when you roll your eyes when I start talking taxes, same thing is going to be here, is come to us or come to your professional, your accountant, to rely on some of these detailed. And that could be your internal accounting group. It could be your external bookkeeper, whoever it is. Just know that there are resources out there for you.
And also be aware that we don't have to rush this process either. The banks, you have 6 months of payment deferral anyway on this PPP program. So during that time period is when you will be gathering information in order to fill out this forgiveness application. Then the bank has another 60 days. It's possible Congress may extend that 60-day period, because from what we can tell, how can the banks handle 4 million or more loan forgiveness applications within 60 days? So that might be an impossible feat.
Yeah. In today's day and age, it's hard for us. We're in this uncertainty here. We want to have some certainty. So something we can do is, well, we want to get this loan forgiveness taken care of. Well, you can't even apply for it until July 1st because you have to be done with this period, for one. And then two, just know the banks are going to be inundated again. And so you have this 6-month period. And so even though we want to have some certainty in here, there's time, there's patience, that we don't have to rush into this. And again, remember that this is a loan first and the forgiveness second. So I see a lot of business owners calling me up now and saying, well, I got this funds and it's sitting here in an account. How do I spend it? Well, you can spend it. It's okay to spend it. Don't let it just sit there in an account. Use it. Go through as when you outlined it, you said what you're going to use it for: payroll, rent, utilities. Use it. You don't have to wait until the very back end to move it from one account to another. It's okay to use. And that's what this is for. This is what we're trying to talk you through on this forgiveness side. Is yes, we're going to ask for forgiveness on it, but the loan is there first and foremost. So use those proceeds, and it's okay. So,
well, should we jump right in?
Yeah, let's do that. So. The first thing we wanted to talk about here, and as we work through this content, there is a lot of information on this application, and a lot even more detail that are in there. You're going to actually find that this presentation isn't as detailed as some of our other ones. There are other detailed presentations that go line by line by line. We can reference some of those. The SBA has put one out. The MICPA has put one out. Great resources, very detailed, lots of examples. But what we're going to go through here today is to really highlight some of the differences that we have noticed as a result of this actual forgiveness application coming out. So what is it that they provided specific new guidance on? What is it that they clarified? What is it that they forgot to clarify or didn't clarify? And so the point of what we're going to be doing today is just focusing on those differences from what we've thought in the past or the new things that just got introduced as a result of this application. So kicking it off is we're going to talk about is the payroll cost. That's, if you remember, the fundamental part of this overall program. So everyone by now is very comfortable and very familiar with that 8-week period. So we've hit it in very hard that you got the 8-week period from when you got the loan, and it starts when you can start spending. So the coverage period is what that's called. What this new application did is it entered into a whole new idea, a new 8-week period, which is the alternative coverage period, or what I'm going to say is it's the CPCP or APCP. And that alternative coverage period is a result of, I think it was the AICPA that were pushing in the payroll, the ADPs, that were pushing to say, hey, by putting this in here on this 8 weeks as it's defined by the loan, that's really throwing a wrench on the ability for accounting. And you're going to have this split payroll period here. So, if you get the funded on a Friday, but your payroll starts on a Monday, how do you do the weekend? Do you do in pro rata or are you not? What we saw through this application here is they are really trying to ease the administrative burden through this, which was great. I mean, that was what a lot of lobbyists really pushed for. The organizations pushed for is just an easing of that administrative burden. So what they came out with is this alternative coverage period. Is only for the payroll part of this, so not the other costs, but for the payroll costs, it allows a business to elect to use this alternative period. And that alternative period is the first day of your pay period following your loan application, the funding, I mean. And so let's say you get funded on a Friday and your payroll pay period starts on a Monday. Well, you can elect to either have your 8 weeks for the payroll portion start on that Friday that it was funded, or it could start on that Monday, that following Monday. So that way you can have just a nice full coverage period within it. You're going to have to look at your individual circumstance to determine what makes the most sense within that. Some may want to do an allocation. Some may not care because, again, we're going to backload the costs versus front load them. But if it makes a difference for you, you have that ability now to go into it. So I see that as being a nice added feature. Right.
That alternative period is really designed so that you can select an 8 weeks that fits your natural payroll cycle.
Yep.
And I'm going to throw this out here, John, too, that there's still a little bit of guidance needed because the instructions in the PPP application talk about paid or incurred now. It's not it's not incurred and paid, but paid or incurred. So there's still some debate as to whether or not we have to do a weird split payroll. One thing we know for sure, though, is we don't have to hustle up and do any sort of special payroll at the end of the period.
Yeah, and that's a huge thing that I've been advising a lot of our clients is to plan on knowing that you're going to have a special bonus. We may still get there, but we don't need to do it. We know we now have the ability that we can just use the natural pay period. And we're going to go through here in today's presentation and really highlight why we would choose a natural period versus not. And I think that incurred versus, and we were doing the incurred and paid. They gave some specific guidance for that. And so there's still a need for clarification, but it did give a little bit more clarification as well. But yeah, so that the idea, like you mentioned, is it's meant to be that natural period. They're trying to make this as easy as possible so we don't have to come up with all these complicated schedules and everything that comes with it. If you want, you can take the simplified method and just say, hey, my payroll period starts on a Monday. That's when we're going to start our 8-week period on a Monday. So that way you don't have to do all these proration. Some smaller details on the clarifications, and you're going to see them here on the slides. They clarified that the paid is deemed when it's dispersed or ACH is originated. So like if you're using a payroll company or using an ACH feature, it's when it originates, not when it settles. That's getting into the very details, but that's important. It's the origination date or a dispersed date, so when you write the check. On wages, you earn the wage the day, not necessarily when the payroll, when they're paid for it. It's earned when they actually work it by the day. Little nuance there, bonuses. Bonuses generally, unless you have a very predefined period of when it's earned, bonus is generally figured out to be is the day that it's paid. So keep that in mind. That's where you may want to do a final payroll, is if we need to do some bonuses here. So that's something that kind of throws a little bit of planning inside of it. But and a new one that we had here that was added was the ability to treat, this is that incurred and paid, that we can treat bi-weekly or more frequent. So think bi-weekly and weekly. So this does not apply to semi-monthly or monthly. But bi-weekly or weekly payroll, you don't have to do the split period if you don't want to, because it allows you to, if the wage is incurred during that period, the covered period, but paid after, it is allowed as long as it's incurred and then paid within the normal payroll cycle. So here again is example. Say that the 8-week period ended on a Wednesday. The employee earned it on a Monday. So they earned on Monday, the period ended on a Wednesday, and it wasn't paid until the following Friday. Well, if that following Friday is the first normal pay period that it gets paid, those first 2 days are allowed, so the Monday and Tuesday. Now, if your period ended on that Wednesday, the pay on Thursday doesn't count because it was not incurred and paid. So what that exemption or what that exception is allowing for is if it's treating paid as being paid in the allowable period, as long as it is paid within, even if it's subsequent to that 8-week period, if it's paid within the normal cycle of when something gets paid.
Right, your next regularly scheduled pay date.
Yes, that's the key there. And then within the payroll cost specifically, something that they came out and talked through that was new here, or clarified, not new, is the compensation is based on an annualized period. So there was a question of whether is it a week by week based, but you got to keep in mind it's annualized inside of there. So this gets into what if I pay an employee nothing for the first 2 weeks and then pay for the next 6 weeks. It goes by the annualized period for that 8 weeks. So if you then pay extra the later part of it, the limitation is not a weekly limitation. The limitation is based on an annualized based. Shifting a little bit here, we're going to shift into the non-payroll costs. So everything we talked about before there or up to this period was the payroll portion. This is the non-payroll portion. A couple of the new things that we saw, the paid now adds, the instructions have removed what appears to be the incurred requirement. This is, Jeff, what you were saying about earlier, is we want some more guidance, because it's interesting, the new guidance they provided added confusion, unfortunately, on this one, is whereas before we were saying it's paid and incurred, well, now we have this little bit here that says, well, as long as it's paid, even if it was incurred before, it's okay. I think if I step back, what they're trying to do here is say, look, They want to keep it during what you would normally do during that 8-week period. So as long as you're not trying to game the system or trying to take advantage of it, do what you normally would do. So if you have something that was incurred prior to this but normally paid during this period, it's probably going to be okay. If it's incurred during this period and paid after, as long as it's paid within the normal course of what you would pay, it's going to be okay. Again, don't use this as an opportunity to game the system or to really squeeze every little dollar out of it. That's not what they're intended to do here. They're intended to make it administratively easier. Is that your take as well?
It is, certainly. And this helps with types of utilities perhaps, or health insurance payments, where you usually pay now for the following month. So it kind of helps with those issues.
Yeah, and let's use that as an example. Let's say your electric bill. The goal on the electric bill is that you have 2 months worth of electric paid in here. So if you pay 2 months during this period, they're not going to have you dig into whether or not, okay, the March service invoiced in April, paid in May, is that a March, an April, or a May? It's just a 30-day period there in that. So again, they're trying to get you to just simplify the overall process that you're allowed to get 2 months worth of electric bills during that period. Yeah, we're going to try to look which is the right one, March, April, or May. We're going to look to figure that out, but don't try to game it. Just try to say our goal is to find 2 months worth of utility bills. That's the goal, right? I mean, that's what your take on it. So the key within those, though, is that you have to pay it on or before the normal course of business. So again, let's go back and let's say your 8-week period ends on June 15th, and the bill isn't due until June 25th. Well, if you pay it on June 25th, it appears that it's going to be okay if that's the next time it's due. So they want you to just do the normal course of business. Now, if you have a prior period and you did it on the March and April payment, you get 2 of them because you get 8 weeks or 2 months. You don't get to triple up in there. You get to have that 2 week. It's designed that you get 8 weeks of an annualized basis. Rent, they did come out on the rent and they clarified that rent is now allowable for personal property. We kind of assumed this was going to be the case, but they clarified it. So rent, that's on vehicles, equipment. So like if you have a rent on a high-low or you have a rent on a postage machine, it's personal property is now allowed. Key with this is it has to be in the business name. So a lot of individuals may have a reimbursement for, let's say, an auto lease. Well, if the lease is in your personal name, it doesn't qualify. It's rent that's in the business name. So it's both real property and personal property, but it has to be in the applicant's name.
And you still needed to have had that lease in place by February 15th.
Correct, yeah.
Something new that ended up in the instructions in the application for forgiveness is owner compensation has been completely separated out and is reported totally different from the rank and file staff compensation. One biggie is the Treasury has placed in the instructions a limitation on owner compensation, meaning, number one, we always knew that we couldn't go over $100,000 annualized salary during this 8-week period. Well, Treasury doesn't want owners to give themselves a raise during this spend down of the PPP money, so now it's going to be limited to the lesser of $15,385 or 8/52 of the year 2019 wages that the owner had earned. So if you as an owner had paid yourself $50,000 salary in 2019, you'll be limited to that 8 weeks worth of $50,000 on this application.
This is probably the biggest change that we saw. Everyone should hear this. If you have one thing that you hear out of this presentation is to be aware of this limitation that is there. I mean, it's a big change. It doesn't surprise me. When I first heard this, I was pretty annoyed by it. I'm like, okay, why are they entering this now? We all knew that they were going to put in safe harbors and things to stop business owners playing games on this. Again, we step back. If you remember the first presentation we were talking about, this PPP program is not for the benefit of the employer or the business. It's for the benefit of the employee. And so if we really step back and think about it, the loan, thus the forgiveness, but the loan was based on 2019 wages. And so if there's a business owner, you're trying to increase your amount that you're getting as forgiven, really what you're doing then is if you had less of a wage in 2019 and you want to increase it over here in 2020, you're doing that at the cost of another employee. And so that's what the loan is really trying to avoid. They're saying, hey, if you got the loan based on 2019 wages, the forgiveness should be based on 2019 wages as well. And so employee or his owner, don't play games with it. That's really what they've come out and said, is that you're limited based on the 2019 wages. So like you said, if you made $20,000 last year, you can't give yourself a raise to be making $100,000 this year. You got to stick with what you made. This gets into the whole comment and discussion that you hear us talk about on a regular basis that says you got to do what's right for the business and you got to do what makes sense. You can't just play games one year over the next year. You got to be consistent. The whole point of owner compensation is you have to have a reasonable wage. Well, if you said last year $20,000 is a reasonable wage, to all of a sudden increase it to $100,000 this year, doesn't make sense if it's solely for the purpose of gaming this credit. It would call into question whether the $20,000 reasonable wage last year was not reasonable. So we had talked about it and said don't even do that anyway, but this just certified it to be, just really stuck a fork in the sand, if you will, and said this is what is there. And so it's there. You have to be very aware of it. Because there is some limitations that are out there now, and based on, especially if you're a single sole S corp owner, or maybe 2 or 3 employees, it makes a big difference. So,
unfortunately, many businesses are halfway through their forgiveness period already, and it's interesting how the law can be written one way, and then form instructions come out and contradict the law.
Oh, the amount of changing that we're seeing here is, and you've seen it through the whole process, and it's frustrating. Between the one we had last week where they came out and they added in the affiliated entities for having to have the PPP versus the employee retention credit, just time and time again we're seeing examples where they're changing the rules after the fact, and you make honest business decisions based on what you think given the facts and circumstances at that time, and they come back and change it. It is frustrating. So it's hard to deal with, and that's where you're going to hear us come back and say, use this and do what makes sense for your business. Don't use this as a game. Use this to do and pay payroll. That's what it's for. So this next section is going to be consistent with what we've talked about in these first 2 sections. Is overall, I saw the clarification that came through as part of this new application was that they were really trying to ease the administrative burden that are coming through here. So the actual guidance on the wage rates reduction that came out early on was very complicated, and it had apples to oranges comparison because you're comparing a 12-week period to an 8-week period. What the guidance has now come out and pointed to is that you're using an average annualized income. So you've taken the apples to oranges comparison on the 12 weeks of the first quarter to the 8 weeks of the period, and you're now truly testing them on an apples to apples basis. So it's an average annualized for the beginning of the first quarter period, and then comparing it for the 8-week coverage period is based on an average annualized wages.
And it's nice that it's based on an 8-week chunk now and not a per pay period annualized basis, so an 8-week annualized. That really helped ease that administrative burden.
What I want to point out here too is in the slides that are going to be on the presentation or on the website here, there are going to be some specific examples. We're going to go through employee A, B, C, and D and walk through each line of, okay, how do you compare this one to that one, and where are the limitations coming in, because it is the devil's in the details on this scenario, on this one and the next one, the wage rate reduction and the FTE reduction. We're not going to go into the details on this PowerPoint or this presentation here, just because we wanted to keep it at a higher level. Know that those examples are out there, so if you want to scroll through them, go ahead. We're going to be doing a lot of that planning with each client that we work with, and so it's something you need to think about and be aware of. Just know that the detailed examples are on the PowerPoint presentation that's going to be in the resources to this presentation. We're not going to focus on them here, but they are available. So on the wage rate reduction, what we wanted to highlight here though is that this is on the employee by employee level. So the FTE is on the employer level, the wage rate reduction is on the employee level. So they came out and clarified that. So when you're doing these 2 reductions, it's important to know the difference. Wage rate, you effectively have to look at every single employee and you compare, was the employee compared to the first quarter compared to the 8-week period. It's employee by employee basis. It's not averaged for the whole company. It's employee by employee. Whereas the FTE is employer basis, so it is averaged overall. So if you have one employee that worked more, one that worked less, it's averaged overall. So
The second calculation for calculating loan forgiveness, or a reduction thereof, would be this full-time equivalency. And this is to determine whether or not you have reduced your headcount. And so over the 8-week period, instead of coming up with full-time equivalent based on 30 hours, as so many of us were thinking it would be, it's actually going to be based on 40 hours. And so it's a number of hours worked divided by 40. So no employee for this calculation can go over 40 hours. So if you have someone who works 45 hours per pay period, it is a 1 full-time equivalent. So a maximum cap at 1. Anyone who works less than 40 hours, the instructions have given us a safe harbor. So now you can just count them as a 0.5 full-time equivalent, instead of messing around with all of their hours and running the math on that. So that was a welcome change in my mind.
yeah, and that's an either or. So you can either choose to do the every employee, or you do that anyone that worked 40 or more is treated as 1, and anyone that's less is treated as half. And that's the simplified method. And so you just want to, it should be about close and similar, but certainly if the simplified method works for you, and it will ease the administrative burden of looking at every single employee, it certainly provides that simplified method that's there. The big change on this one is that 40 hours. I think even our spreadsheet that we had passed on had 30 hours, and that was what the initial guidance had talked about, which is what it appeared they were looking at was the full-time equivalent as defined by the federal government, which was 30 hours. But here they've now come out and said it's 40 hours. So that was a big change, and that is going to change some calculations that we look at it. My observation just in general, when I look at the two limitations, so there's the wage rate limitation, the reduction that attached to that, and then there's the FTE. Again, they want to make sure that you didn't lower someone's wages, and they want to make sure that you didn't lower headcount. My observation, looking at what I see here, is that by and large, employers did not lower the individual employee wage. So most employers didn't say, you were making $15 before, now you're making $12. In fact, most have to go the other direction because you're competing against unemployment. So you're going to go with 15, and oh, by the way, I have to give you a bonus to get you to come back. By and large, I see that one as less of an issue. Most employers are having to actually pay more per hour to get people back. I see the FTE as the one that might come back and trip up more people than not, where you may have, you may not have called all of your employees back. So that's the one that I see that you really got to focus on. Both are important, but if you're going to pick one to look at the FTE one, because I see that as being more limiting than the other.
Right, and we're also going to see a little later in this presentation that there are some safe harbors here that will allow us to restore these headcounts.
Yeah. So some great exceptions that came out of this the actual application, which was welcome to see. One of them, and this particular one actually came out earlier, but if you have a good faith written offer to rehire someone and they reject that, so if I had laid off Jeff here and I said, Jeff, I want you to come back, and you say no, it's not my fault that I didn't offer it back. If you made a good faith effort, if I truly extended out to Jeff, I'm hiring you back at the same rate for the same hours, and Jeff decides to stay home, it's not going to harm you. That's up to Jeff. That's not up to you. But he is working still, so don't worry. And then some of the new guidance that came out, though, which is clarification is nice, is that any employee which during the covered period, so fired with cause, voluntarily resigned, or voluntarily requested and received a reduction of their hours, that also does not harm you. So if you had an employee that for whatever reason is using this opportunity to move, or if you fired them for cause, they are deemed as having been employed that whole period and still there. So that was pretty important and pretty critical. So
we had lots of questions on that.
So on these exceptions here, one thing to note is you can't double dip. So where I just got done talking about if an employee voluntarily resigned, let's say, if you then rehired that position back, you can't treat that as one that you had the person resign and then I hired another person back. You can't double dip. That's not two. That's just one. So the point is trying to treat this as if you're trying to treat this that you're not going to game the system. That you're just saying if you had 12 employees before and you maintained 12 employees or tried to make 12 employees, you're not going to get limited. That's the point. It's not trying to be creative or not trying to be overly complicated. It's trying to allow you to just do what's right and hire back. They want you to hire back and get you what you were on February 15th. So that's the best way to think about it. Again, some of the slides that are in the actual attached reference go into a lot of the detail on the February 15th compared to the March 31st date, compared to the specific deadlines and specific times. We're not talking about that in this presentation here, but the details are there.
So as we said at the beginning of this video, there's a lot of documentation that needs to be attached to the application. Payroll records, bank statement transactions, canceled checks, copies of utility bills, health insurance bills, so on and so forth. So lots of information material. One thing that I think is helpful is that if you have a nicely formatted report from a payroll service provider, or maybe within your own payroll system, you can use that report in lieu of what may already be pre-printed in the application, so you don't have to recreate the wheel there. But overall, how long do you need to keep this documentation? Well, it's for 6 years. So 6 years after loan forgiveness, or 6 years after you've paid off the unforgiven portion. So this is quite a lengthy time period to keep this documentation.
It is. It's a lot of documentation that comes with it and a lot of complications. And I think, Jeff, to highlight one thing you mentioned is, to the extent that you can rely on a third-party provider, do so. That's what they're looking for. They're looking for you to verify from someone else. So if you have a third-party payroll, so if you have integrated payroll, if you have ADP, if you have another payroll provider, use those reports. We're in contact as a group, and ADP is in contact with the IRS and the SBA, and they're coming up with the guidance that says, here, use this report, and that will be adequate. Because what they're trying to do is simplify for you. They're trying to verify that you're not, as the business owner, gaming the system. So if you've got someone else to corroborate it, use that information. Absent that, they're going to look at bank statements, and they're going to look at all these tax forms and all these other third things that you're going to have to keep for a long time. And what it really comes down to is, if there's no documentation, there's no forgiveness. They're very clear. It's bold in the application. You are going to have to document. And those documents are going to be pretty rigorous.
And a great example of a report that your payroll service provider can provide is that calculation of full-time equivalence. And that can be calculated for any time period that this application needs. So that can save you quite a bit of time.
Yeah. And this is going to bring us back to what we started off the presentation talking about, is we're at that detailed stage. And just like as a business owner, you wouldn't rely on you being the one that documents every single thing for a particular payroll, or documents every single thing for paying utility costs or otherwise. The same is going to be said here. There's a lot of detailed calculations, a lot of pulling together invoices and coming up with schedules. So whether you use your internal accounting department, your third-party a bookkeeper, us, a payroll provider, use your professionals. If you want to, do it. And so don't hear me saying not to. But really ask yourself, is now the time to really learn all these nuances? I mean, we just spent the whole duration of this presentation going over just the small new changes that got added by one application, and we're skipping a lot of detailed calculations in there. If you want to learn them. And hear from us, it's okay. We'll teach you and we'll show you these. But this is where you really got to ask yourself, is now the best time to become an expert at this? And on that note, know that we're here for you. Know that Jeff, Katie, anyone here, myself, we're here to go through this. We are starting to do the process of reaching out and talking to the clients that have gotten and received the PPP to determine whether or not we're going to be helping with it, whether you're going to do it internally. We put this out here so that way if you choose to do it, you can. We're here for questions, but we're also here to actually go through those applications with you and alongside of you. If you want us to help, reach out or talk to your particular CPA, whatever would make the most sense for you. But know that we're here for that. And we're going to continue to provide and bring new information for you as it comes up. We're anticipating there's going to be new guidance, further guidance that comes out. They've alluded to that and we're expecting it. We still don't know about related party rent, whether that's going to be allowed or not. And there are several other new questions that came out as a result of this. know that that's coming out. We're going to continue to provide this. We're going to continue to bring webinars like this. You might see us switching gears a little bit. I would really suggest you look at last week's presentation that talked about thinking proactively during this. If I were you as the business owner, I would definitely tell you to spend more time thinking about that than the details of this particular PPP application. I know the natural tendency is to dig into that, but look and spend more time thinking about the proactive as a business owner, what you should be doing right now, than looking at all the details. They're both important, but you can make a big difference on your long-range success by looking at your focus and your goal and your aims versus just looking at the detailed here. So know that we're going to be bringing different topics to you over the next all summer long. What that looks like, we're still trying to figure that out, how that is. We were planning on having some on-site webinars or seminars for you. We don't know what that's going to look like, whether we're going to have those or how we're going to have them. But we just keep coming back for this. We appreciate the continued attention here and the continued votes of confidence as we keep putting these out, that we're here for you, and we appreciate you attending.
Thank you.
Well, we're switching over here from being the pre-recorded to the live Q&A, so thank you for making that shift with us. And as we bounce around a little bit, it's we're trying to get more advanced on the technology side of things here with this and doing some pre-recorded, some live, so thank you for that. And thank you for spending the time with us this afternoon and making it as far as you have. So I hope you had a great Memorial Day weekend and were able to get out and enjoy some of the sunshine. We've got Jeff Wood here, myself, John Sluice. We had several questions here that came in during the presentation. If you do have specific questions, we can still see them on the screen here as well. So please feel free to put them into the Q&A or the chat. We can see both of those. So these questions were ones that came through earlier in the presentation today. But if you do have more, feel free to ask them. So with that, we'll just jump right into it. And some of these, by the way, may have been answered inside of the pre-recorded, but we'll allude to them as well. And that, I think, fits with his first question is, I heard online that I can't do a bonus. Is that still possible? So,
Well, bonuses are definitely part of the definition of payroll costs or compensation. So a bonus is a good strategy to utilize your PPP funds, but we do have to caution that there's a limit to what can be bonused.
yeah, I feel pretty comfortable saying that, but I also saw guidance or emails out there about not being able to do bonus this past weekend and in the media. I feel very comfortable saying that you can do a bonus. Bonuses are allowed, and that in fact, I would say that I feel very comfortable within the way the guidance came out on this forgiveness, that the way they look at it is an 8-week period. It's the average of the 8-week period. So again, with the theory on the bonus is maybe, well, I didn't have 2 weeks worth of time, and then now I have 6 weeks. Is it by week or is it for the 8 weeks? And I feel pretty comfortable that it's the 8-week period as a whole. So if you need to do a bonus to make up for it, so be it. Keep in mind, you do have the interplay with the unemployment. So all we're talking about here is making up the specific forgiveness on the PPP loan. We have to be very careful that if you took unemployment early on, that you're not paying back wages. That is truly a bonus. So you have to meet the definition of the bonus. There's also an interplay that I've cautioned on, that you have to be careful you don't pay overtime. So I've talked to several clients that have wanted to pay a bonus based on the number of hours worked earlier in the period. Well, you got to be careful. If you're basing it on hours worked, there is guidance out there that would say, well, if they worked already 40 hours and you're paying more and they're on overtime, some people may make it and some people won't. So if it's based on hours worked, you've got to look in that respective period too. So just be cautious and be careful about when you're paying bonus. But that's not a PPP thing. That's a general bonus consideration. So
That's a good point. And also, it needs to be something that you normally would do in your course of business as well. It's not to say that bringing people back during this pandemic doesn't mean you can't pay some sort of a hazard pay.
Right.
That's something else that clients are utilizing.
Yeah, so when you're saying in the normal course of business, in hazard pay, you have to have business reason to do it. And the business reason can't be solely to maximize the loan forgiveness. And so you don't want to pay someone $6,422 and another person $3,174 just to maximize the PPP. That doesn't make business sense. You have to have a rationale and a reason why you're doing what you're doing. And it has to have business purpose, not outside of just getting the forgiveness. So,
And then I believe we've covered this before, but this number, $15,385, that is the maximum that you can pay one employee over the 8-week period in order to have that count for forgiveness. Correct. Anything more than that will not be forgiven.
And then that leads into another question that actually came a little bit later, but can I pay my wife or son? And I think what they're really getting to there is the family attribution rules in what you were just mentioning, that limitation on the $15,385, that's further limited for business owners. And if you are a business owner, it's either the $15,385 for the 8-week period or the average 850 seconds of what you made in 2019. So I'm alluding to this question. I'm thinking the question is saying, well, I was capped out, so can I now pay my wife or my son? Or so what I hear is, Mike, can you pay family members? And interesting enough, as Jeff, you and I were talking about this in unrelated, but was that we do have what we refer to as attribution rules, or related party rules. And interesting enough that we have multiple authoritative guidance here. So Jeff and I, we're tax accountants. We normally default to the Internal Revenue Service, and thus the Internal Revenue Code. That's what we know, that's what we feel very comfortable with. And that's where we talk about attribution and family members as we refer to what's in the Internal Revenue Code. The SBA is a different authoritative guidance. And from what we've seen, that they're the ones that are overarching and they're in charge of the PPP and the PPP loan forgiveness. And therefore, it seems like it would be the ones, they're going to be the authoritative guidance that we'd look to find for attribution rules. And we do not generally see a limitation on the spouses or children. They're absent the limitation. In fact, they look at each applicant separately. So the business owner is just the business owner. And then the applicant is, the spouse is a separate individual. And so you'd have to, if that spouse was also an owner, then you got to play into it, but there aren't the limitations like you would see into the IRS.
Right, and I would say we should probably just throw up a little bit of a cautionary flag here because we know that the form is still in work. There's more guidance to be issued on its form instructions. So there's always a chance. We've seen this already countless times. There's a chance that the rules will change. Yeah. And then they could say a family member of an owner is going to be limited, just like an owner would. Yep. Meaning, was that spouse paid in the prior year? If not, their wages can be limited this year. And
I alluded to this in the pre-recorded section of today, but if you step back, that makes sense. And the idea being, it's limited to 2019 wages. And so if you all of a sudden push in an owner, or for that matter, hire a new person, you're taking wages away from someone that had it before. And so if you're giving to a spouse all of a sudden, it's because you took those dollars away from another employee. And do you really want to know that? To me, it gets back to just assume that your employees could get the detail of what you put out there. Would you feel comfortable with them knowing that a spouse made a bonus differently? It has to have business reason, and you got to be able to stand behind it. That really is what it comes down to. So,
right. Next question. I received an email this weekend from the SBA regarding the EIDL loan. What do I do?
I think a lot of clients got that. We've had several questions on that today. It's not related to the PPP per se. We were actually talking when we were prepping for this presentation earlier that the forgivable part is on the application itself, but it doesn't really interplay with the calculation of what's forgiven. And so I think...
Yeah, in particular, the EIDL advance. Mm-hmm. So the advanced funds, not the loan, but the advanced funds, the PPP loan forgiveness application has a line where you have to report how much you received from the advanced funds. So there's some sort of interplay there. Yep. And as we were speaking earlier, John, I recall the banks, as you were applying for a loan, a PPP loan, if you had already received an EIDL loan advance, then your PPP monies would be reduced because of that advance. So there's some interplay there. I'm not quite sure yet how it might impact forgiveness.
And that's, if I step back again and I look at it, ultimately the PPP and the EIDL loan are both SBA programs. And so they're not going to allow you to double dip on the forgivable part. So if they're not going to give you 100% PPP forgiveness and the EIDL 10,000 up to 10,000 would be my guess.
Right.
There's a chance, we're still waiting to see that, but I would not plan on that. But what we do see is that there is a lot of discussion on limitations on the PPP and the regular loan part of the EIDL loan. Both of our interpretation on this is that you can get both. We're going to have to rely on the further guidance that's coming out yet. So this email just came out. We're still seeing guidance afterwards. We're going to have to rely on ultimately your bank, because that's really who this is coming through, is the bank part of the forgiveness, and the EIDL loan is through the SBA, but they're going to have some discussion on it. But it is our understanding that you can have both of them. You just have to be very careful that you don't use them for the same amounts. So if you received a PPP loan and you use that to pay payroll and pay rent, then you can't use the EIDL loan to pay payroll or rent. But you could use the EIDL loan to maybe, say, purchase supplies or costs that you otherwise would have needed to have that aren't qualifying for the PPP loan, but would qualify for the EIDL loan. It's a true disaster loan. And within that question, I'm assuming what you're asking about is, well, do you follow up and get it? Do you not? I think that's a case-by-case basis. It's truly a loan, and you have to ask yourself, you're signing up for a 3.75% SBA loan. I personally think that's very good interest rates for very good favorable terms, and it's going to probably be on a case-by-case, but you should definitely talk to your accountant to see whether it makes sense to get those loans and if you need them or not. So
it's my understanding too that, well, the EIDL loan itself can be used for much broader purposes, one of them being to pay fixed debt obligations. So this might be a chance to work on lowering a higher interest rate debt in exchange for this EIDL loan.
Yeah, there's definitely, I've been a big fan of the EIDL loan early on this, thinking that truly that's where this is the business's benefit. So you've heard me say the PPP loan is not for the benefit of the business, it's for the benefit of the employees, whereas the EIDL loan or the EIDL loan is, in my mind, for the benefit of the business. So it's going to be able to get you through this cash flow crunch if you truly have one. And that's what it's really going to come down to, is do you really need it or not? And I think there's a lot to be said about looking and see what's available.
So John, another question here. What if I don't call all my employees back? So let's think of the restaurant groups. I know we're just now starting to open restaurants. Some of the health practices, dental practices are able to open, but many just aren't able to call everyone back.
Yep. Or I talked to someone this morning that was a hair salon, and they're still not open. And the governor of Michigan just came out and said that we're going to be closed through June 12th, and so we know for sure it's going to be that long, or likely, and it could be longer. So I'm assuming inside of that question what they're saying is, well, gee, what if I can't have payroll costs? Well, my take on that is you either have to decide, do you give the PPP back or do you pay your employees? Again, you've heard me say this multiple times, is the PPP is not for the benefit of the business owner. It's to get the business to think like an unemployment agency and get the people off of unemployment and have the business pay for unemployment. That's the fundamental purpose of what that is. It's not for the betterment of the business. It's a federal thing. It's not a state of Michigan thing, so keep in mind that I've seen lots of emails or requests to the governor of Michigan specifically asking about, well, can you extend it to the 12 weeks or 24 weeks? I would feel that would be great if that happened, but I'm not anticipating it because it defeats the whole purpose of the PPP, which is A, it's a federal funding, so you'd have to have consistency across all 50 United States for one. But two, the idea of it was to get businesses to pay payroll when they otherwise wouldn't have. So that gets into the question, what if I don't call my employees back? It doesn't matter if you don't have your employees there or not. The PPP loan wants you to pay your employees, even if they are sitting at home. So.
And some employees really don't want to be called back either. There's been pushback. And I believe we covered this before, but as long as you have some sort of written documentation that you have made an offer to rehire and that offer has been refused, then you at least won't be penalized in your pursuit of having that portion of the loan forgiven.
Yep. And we talked about that in the pre-recorded one, is the not being penalized, but also if you have someone that you've terminated for cause, or if they've quit on their own that they wanted to, or you placed.
So part of what this question is getting after too is I might have $15,000 still sitting there that I haven't been able to spend because I didn't have my employees
back.
Yep. So at that point, you've got a $15,000 loan, you can choose to repay immediately or stretch it out.
And it gets into whether or not you qualify. So again, there's two buckets there. There's the forgivable part, but then there's the authorized uses. And can you even meet the authorized uses if you don't open back up? And that's definitely a case-by-case basis and something you should look at, because it's going to get to the wages you paid from February 15th through like the March 23rd, let's say, when they got shut down.
Yeah, that's a great reminder. So February 15th was the start of the qualified use period.
Yeah.
So quite a few people could have their qualified use covered already because of that.
Yep. But definitely look at it. If you're in that case, talk to your accountant and we can walk through some scenarios. So one question here is they wanted to know whether they can pay a March invoice. So I'm guessing that's getting into the 8-week period, and I'm assuming that it's probably a March invoice is before the 8-week period.
Right. So if let's say we received the PPP funds first part of May, so we have all of May and most of June to pay these expenses. The language in the application talks about costs incurred or paid. So if you're paying a March invoice in the 8-week period, well, you are paying an expense that normally would be qualified, but you didn't really incur it during that 8-week period. But yet, there's also other language in the payroll situation where, or even utility bills, where you can incur the expense during the 8-week period, but you don't have to necessarily pay it if it's not due until after. Mm-hmm. So if the regular billing cycle is due after the 8-week period, then you still qualify for forgiveness. Going backwards in time, though, back to March, where you are, in essence, maybe trying to pull in a third payment. So the natural 8-week cycle would cover 2 monthly bills, 2 rent payments, 2 utility payments, that sort of thing. If you are able to pull in a third, I believe that is probably not the intent of this. Although the language seems to allow it, but I believe there's going to be more guidance on this that will limit that.
Yeah, that's what my takeaway was, is the language seems to allow it, but it's whether the intent is there. So I have a feeling that we might have some clients that are going to do it and some that aren't. And it's going to come down to what is your ultimate comfort level of, are you trying to really push every single dollar out of this, or are you trying to get to what the intent is? And
throughout the application, there's other instances where it seems to allude to more of the natural billing and payment cycles.
Yeah. And there, I think the overall urging is just don't get greedy. Make this the business intent. If you pay in payroll, that's probably going to be where most of the dollars are, but make it business sense. Don't try to push this. Use it for what it is. So, my rent is due on the 1st. Is that okay? So I'm gathering probably, again, what they're getting to is that your payroll, the 8 weeks didn't come exactly on the 1st. And so what if I have March rent April 1st, May 1st, and then, so do I have to prorate or not? Again, I think what it's going to get to is if you can make 2 rent payments and incur 2 rent payments during the period, great. It gets to the illusion, could you hypothetically do 3 months? Potentially, if you caught up 1 rent and then paid for before. But you got to have to be very careful that you're not prepaying for rent and you're catching arrears. And again, it's going to go back to, I think it's probably going to be at a case-by-case basis to make sure that the intent is that you get 8 weeks worth of expense. And so if you're going to try to push to get 3 months in there, maybe, I don't know. We'll have to see. So.
Yeah, I think probably the best example would be you received a loan on May 5th, but you already paid your rent on May 1st.
Yep.
That May 1st rent payment is for the entire month of May, which means you incurred cost. Incurred costs that would be eligible. Right now the language does say paid or incurred. So there's a possibility that you could submit that May 1st bill as your proof when you submit everything to the bank.
Yeah.
And there's a pretty high likelihood that will be counted as long as you are only trying to claim 2 months worth.
Yeah, and it gets back to the perfect example of what they're trying to give the benefit of the doubt is saying, look, we recognize that you might have paid it May 1st, and let's not do all these prorations. So they're trying to open up the guidance. Don't abuse it. They're trying to make it so this is not an administrative burden. But I'm sure there will people that will abuse it. Absolutely. Whether or not you do or not, that's going to be up to you. So,
I don't see any other questions coming
No,
in.
I don't. I think the last one I'd end on here a little bit is on the bonus specifically, or the payments of getting into. I had this question earlier today on, can I do my safe harbor match, because it's not out. It's not part of the normal 8 weeks, and is it allowed? Is it just on the 8 week period, or is it allowable? I keep coming back to the whole point of this is to keep business going on like you normally would. And so if you normally would make your payment during this period, let's make it during this period and stand behind it. If you don't, do we want to try to, say that we've got the safe harbor match on the 8 weeks of pay? Yes, let's try it. Let's certainly do that. But it's going to come back to just keep things going like you normally would go. That's the whole point.
Yeah, John, you and I, we sat in on another webinar recently, the Small Business Association of Michigan. Mm-hmm. And one reminder that they gave us was, remember what you used to apply for the loan in the first place. Many businesses would have used your 2019 safe harbor matching, mm-hmm. profit sharing. If the bank allowed that loan to go through, then chances are they're going to allow the forgiveness side of it as well.
Yeah, but there again, on that, when you use the average, it's 52 weeks divided by 2.5 months. So they're assuming that period. So
yes.
you follow the similar intent there is what we're getting to. So
right.
That's
that
the
monthly
key.
Average.
Yeah, the monthly average versus paying the whole thing during this period. So we're going to do specific examples in the slides that are on the website. We did not go over those here in detail today because we're already at 58 minutes and we're doing our best to keep these at an hour because we know if you're still listening, you're doing fantastic. So thank you for that. But the specific examples do dive into employee A, B, C, and D. Definitely a thank you to the MICPA for that. We're just grabbing those examples right from the presentation that they did. Definitely give them a kudos. And if you want to go check it out, if you think this is exciting and fun, there is a plethora of tax and accounting information there that even deeper dive. So if this was not deep enough for you, there is definitely more information out there. If not, give us a call. We're here, Jeff, myself, Katie, and the whole group here. So give us a call, email. We're working through. Thank you for joining.